Good afternoon. My name is Kevin Prey, Customer Risk Manager with Ardent Mills, and this is the November 10th, 2014 edition of the Inside Scoop Market Review. In today's scoop, we will review the most recent November USDA WASDE report, highlighting notable changes to wheat and row crop S&Ds, analyze the market's reaction to the news, and highlight risk management opportunities for customers heading into the 2015 calendar year. This morning, the USDA released its November World Supply and Demand Estimate, or WASDE, to the market. The November WASDE report tends to be less significant than others, as the U.S. row crop harvest winds down and market participants shift their focus toward grain demand and planning intentions for the next crop year. Due to the late harvest timing this fall, today's report did include an update to the U.S. 2014-15 spring and durum wheat production, which is usually finalized in October. Market expectations for the November report were for small increases on the USDA's corn, bean, and spring wheat yields, and ending stocks for all grains largely unchanged from the October 10th report. This morning's report did have a couple minor changes to the U.S. wheat balance sheets when looked at from a high level, but included more significant adjustments when looking across the individual wheat classes. The U.S. domestic wheat table saw a slight reduction in wheat production to 2.026 billion bushels, 10 million lower than last month. All other demand aspects remained unchanged, and the lower wheat production led directly to a reduction in the 2014-15 ending stocks of 644 million bushels. 2014-15 U.S. wheat ending stocks remain a 30% stocks-to-use ratio, still comfortable by historical standards. We did see some changes across the wheat classes, particularly a reduction in hard red winter wheat exports by 20 million bushels. Increased competition from Argentina has backed off some of HRW export demand out of the U.S. Gulf and relaxes what was a very tight winter wheat ending stocks situation for next year. 2014-15 ending stocks climbed back above 200 million bushels, or 27% stocks to use. Spring wheat production saw the biggest change of the U.S. wheat classes, with lower production and increased exports contributing to 30 million bushel loss in the 2014-15 ending stocks for hard red spring wheat, with ending stocks falling to 217 million bushels, or 36% stocks to use. Soft red winter, white, and durum S&D tables remained largely unchanged in this report. World production changes were nominal and widely anticipated by the market. Australian production losses had been communicated by the USDA a couple weeks ago and largely offset by increases from the EU. World wheat ending stocks grew slightly to 192.9 million tons in this report from 192.6 in October. We did have a surprise on the USDA corn yield, with the November report estimate dropping from 174.2 to 173.4 bushels per acre, resulting in a production drop to 14.4 billion bushels, or about 150 million bushels below average trade guesses. Ethanol and feed usage were tweaked higher, dropping ending stocks to just over 2.0 billion bushels. 2 billion bushels is still comfortable, a very comfortable stock number, but it is lower than trade estimates and much lower than where the market was thinking 30 to 45 days ago. January's final production, yield, acreage, and stock report will be very important for the corn market and the producers making planting decisions for the next crop year. Globally, Chinese corn production losses have been offset by strong production from the former Soviet Union and Mexico. World ending corn stocks actually grew by about 1 million metric tons from the October WASDE. Soybean yield and production data came in right at expectations, with the USDA estimating 47.5 bushels per acre yield, production at 3.958 billion bushels, and carryout sitting right at 450 million. Still a very comfortable level for the end of this crop year. U.S. bean exports and domestic meal demand have been the key market features over the last few weeks as prices have rallied from the October lows. Bean exports are ahead of a year-ago pace, and weekly grain inspections continue to confirm another strong U.S. bean lifting. Early market talk surrounding dry weather in South America seems to have quieted down, with recent rains, and today's report didn't make any changes to the South American production estimates from Brazil and Argentina, and world supplies adjusted just nominally lower to 90.28 million metric tons. After today's report, we saw some volatility creep into the market, and most of the grains traded both sides of unchanged, with wheat and corn closing higher in the day. Wheat, while higher than a few weeks ago, remains near multi-year lows and presents potentially attractive pricing opportunities looking forward. Ardent Mills would like to highlight the modified capped average as an attractive risk management tool for capping clients' risk to the wheat futures market while enabling our customers to benefit from lower prices should these market opportunities present themselves. We highlight a modified capped average on the Minneapolis September 2015 contract as an example for a customer to cap price risk exposure to the new crop 2015 spring market. Modified capped average, or MCA, acts a lot like a long call option, however has significantly cheaper upfront premiums and provides daily pricing capabilities for the customer. The MCA caps futures market exposure in return for an upfront cost or premium. In this example, $6.4225 per bushel for a 24-cent per bushel premium. Each day the Minneapolis September 2015 market closes below the $6.4225 strike, the client prices a portion of their needs at this level. Each day the September 2015 futures market closes at or above $6.4225 per bushel, the customer prices the same portion at the maximum $6.4225 level for that day. Pricing quantities are usually calculated as an average daily or weekly flour use, depending upon the customer preferences or needs. Upon expiration of the MCA, in this case August 21, 2015, the futures ownership is averaged, the premium included, and then these values are incorporated with the customer's basis and mill feed components to roll up into the finished flour pricing. For illustrative purposes, the daily September 2015 market average, since September 10th, the date we used for this example, is just over $6.01 per bushel. You can see where this structure has allowed the client to take advantage of recent weakness in the futures market, yet caps exposure at $6.4225 should something change in the future. We offer the modified capped average as an example on how risk management can help Ardent's customers capitalize on these historically low futures markets. Other risk management tools are available and can be custom fit to your business needs and risk profile. Contact your Ardent Mills representatives for more information on this or other ideas to help your business and maximize your profits. On behalf of the entire Ardent Mills team, thank you for your business as we look forward to talking to you in the future.